right, so we are going straight away to April 2023. April 2023. Question number 2C. Yeah, so this is RCM College, and this is our number 0719 525,000. All right. So UMI Limited is contemplating to issue. So you're doing April 2023, question number 2C. Once you guys get that question, are you able to put your thumbs up like this? Once you get this question, are you able to put your thumbs up like this? Or you simply say, why for yes? Why for yes? Great, Daniela. Great, great. Thank you very much. So UMI Limited is contemplating to issue 8% bonds redeemable at 100 par value in 3 years time. Alternatively, each bond may be converted on that date into 30 ordinary shares of the company. The current market price is 3.3, and this is expected to grow at a rate of 5% per annum. The company's cost of debt is 6% per annum. So they want us to give them the market value of the bond, assuming conversion occurs after 3 years. Very easy. Market value is based on cash flows. So market value of the bond. Market value of the bond. So in this case, I know that the bond, I will be getting interest. I'll be getting interest per annum. So this has to be discounted. So you multiply this with the PV file. We multiply this with the PV file. So that's the first cash flow. The second cash flow will come in the form of shares that I will get. After 3 years, I'm going to get shares, not money being redeemed to me. So I'll take the value of the shares. So in this case here, plus conversion value. But now remember, this will come as a one-off. So times PVF, like that. Is it PVFA? PVFA is the annual interest. The annual interest. So please let me know once you're able to write this in full. My handwriting at times is not very, very, very good. But the moment I understand that the bond is going to give me two things, interest, and then at the end of the day, there will be conversion. There will be conversion. Have you been able to write up to what Mwalimu has written there? Anybody who has been able to write there nicely? Market value of the bond equals interest per annum times present value interest factor of an annuity. Great. Plus conversion value times PVF. So what may confuse some students here is this conversion value. Very easy. So conversion value will be equal to who? Conversion value. They have told us, alternatively, each bond may be converted on that date into 30 ordinary shares of the company. The current market price per share is 3.3. All right. And this is expected to grow at 5% per. So you can see, ladies and gentlemen, upon conversion, I will be getting, in this case here, 30 shares. And each share today is worth 3.3. But this 3.3 is prone to do what? To increase. All right. So we let it grow. So this 3.3 into 1 plus this growth rate, what is the growth rate given? It's 5%. It's 5%. So 0.05. For how many years? For 3 years. So please remember the 3.3 is current. And we are told it is expected to grow at the rate of 5% per annum. So remember here, what have I used? I've used the formula of amount equals principal into 1 plus R raised to power n. It's compound interest because the dividends will not be withdrawn every year. It's compound interest. So is there somebody who is able to give us this conversion value? Good question there. 103.95. Who is telling me the truth now? I don't know. Who is telling me the truth there? Please ensure that you're raising this very well. Please ensure that you are raising this very well, you gentlemen and ladies. Please ensure that you are raising this very well. $114.6 has taken the day. 114.6 has taken the day. Has taken the day. Has taken the day. Ladies and gentlemen, how about interest per annum? Interest per annum. How much interest shall we be getting every year? Interest per annum. How much interest shall we be getting every year? Remember, it's a coupon rate, an 8% coupon rate. So 8 over 100. It is 8% of the par value. 8% of the par value. Remember, if you read the question very well, we are told UMI Limited is contemplated to issue 8% bonds redeemable at 100 value. 8, thank you so much. 8, like that. Before I answer some question which was asked up there. So then that is it. What you need to do is to go and search for PV for 6%, 3 years. It's a 3-year bond. If you're discounting tables that have this PV for, look for PV for 6%, 3 years. PV for 6%, 3 years. PV for 6%, 3 years. Is there somebody who is able to give me this present value interest factor of an annuity, 6%, 3 years? If it's available on the table, the better. I'll always steal that. 26780. 26780. 26730. Sorry, 30. 30. If the figure is available on the table, don't calculate it. Don't calculate it. And then I can see some other stone that is coming to me at the end of the 3rd year in the name of PV. So I need PV. 6%, 3. Remember, this doesn't have an annuity thing. It's a lump sum. Go to the other table. Go to the other table. Please read for me. Go to the other table. Please read for me. I can see what Raquel has given me. 83.96. 83.96. 83. Can someone else confirm this 83.96? Yeah, Raquel, don't round off to 2 decimal places. It has to be 4 decimal. It has to be 4 decimal places. It must be 4 decimal places. So somebody was asking whether this conversion value is the same as redemption value. No. At times you'll be told that the redemption is at par or redemption is at 130. Conversion is when a bond is being converted to ordinary shares. Ordinary shares. Or picked from the table. Okay. All right. So the interest is 8. The PV for is 2.6730 plus the conversion value. Did I wrap my conversion value? I wrapped it. I wrapped it. It was 114 point something. It was 114 point something. 114.6. It was 114.6 times PVIF. PVIF, which is what here, times PVIF, which is 0.83, 8396, 0.8396, 0.8396, 0.8396. So then you should be able to give me the final answer pretty fast. You should be able to give me the final answer pretty fast. Yeah, Daniela, you seem to be a very, very good student. 117 point something, isn't it? I'm being told approximately, although you should be able to write off your answers in like into 2 or 3 decimal places. 2 or 3 decimal places. So then are we okay up to there really? Are we okay up to there really, ladies and gentlemen? Yeah, thank you so much. Thank you so much. Thank you so much. Thank you so much. All right. All right. Thank you so much. But have we understood? Have we understood what Mwalimu has done really? Have we understood what Mwalimu has done? Have we understood what Mwalimu has done? You know, it's not about like understanding everything, but at least you getting something, however small, that you can use in your exams. Getting something that you can use for your your exams. PVIFA part, okay? So remember PVIFA, okay, first of all, we know that PVIF, the formula is 1 plus R raised to negative N. That's PVIF. And then PVIFA, the formula will be 1 minus this simple formula, 1 plus R raised to negative N divided by R. So then when it is 6%, so we shall talk of 1 minus 1.06 raised to negative 3 all over 0.06. You can as well do it using the formula. Yeah, you can as well do it using the formula. So when you pick your calculator, you say 1 minus 1.06 raised to negative 3 equals, so 1 minus 1.06 raised to negative 3 equals, whatever you get, you say divide by 0.06. Yeah, if it's semi-annual, remember, semi-annual, yeah, you need to look at this topic on time value of money. If it's semi-annual, for example, you would have multiplied this by 2, and this year you divide by 2. A very good videos over that. How to differentiate the concept needs PVIFA or PVIF, okay. So first of all, have you gotten this answer? Have you gotten this answer first of all? How to differentiate whether it needs PVIFA or PVIF? It's very, very easy, because you see, PVIFA, annuity, means repetitive. Like interest will be given to you every year. Every year. That's a PVIFA thing. Every year. And then conversion cannot happen like at the end of each year. Conversion will only happen at the end of the 3rd year. So that's a lump sum amount coming to you. Lump sum. That one you use PVIF. I hope now that is clear. That one you use PVIF. Because interest is normally paid every year. Every year. Interest is normally paid every year. Interest is normally paid every year. So are we together there? Are we together there? Are we together there? Techno. Okay, so then we should be able to move. No response from Techno, unfortunately. So we go to number 2, where they want us to give them the floor value of the bond, assuming redemptions occur now at par. Par is what year? Is 100. Great. Par is 100. Par is 100. Very easy. Very easy. Very easy. All right. Very easy. Nothing really there. Nothing there. So are you able to do for me, Roman, too? Let's see, because now you have everything. Let me see how you guys will be able to get the market value of the bond. Interest per annum times PVIFA plus redemption. Redemption is 1 off times PVIFA. I'm giving you exactly 1 minute. I'm giving you exactly 1 minute. You try doing that for me. Thank you. So remember, interest, yes, the correct answer is supposed to be 105.34. Thank you so much. Remember, interest per annum is still 8. So it will be 8 times PVIF, not PVIF, but PVIFA, sorry, PVIFA here, because it's interest per annum. PVIFA, are you able to remind Mwalimu what you got as PVIFA? Oh yes, I can see the figure. PVIFA was 2.673. PVIFA. Is that okay? Can someone remind Mwalimu whether that was the correct answer? Anybody who is able to remind us? Yeah. Plus, in this case here, the redemption amount. Redemption, now we are redeeming this at par. At times they tell you redemption is at 20% over and above the par value. Your redemption is at par, 100. Times PVIF. You guys were able to give me PVIF 6% end of year 3. End of year 3. You guys gave me this PVIF. You gave me a PVIF of what year? You gave me a PVIF. You gave me a PVIF of you gave me a PVIF of 0.8396. So then this at the end of the day will give me what figure? It'll give me that 105. 105.34 like that. And I'm happy to see that all of you would have gotten this correctly. I'm happy to see that all of you would have gotten this correctly. Great. Thank you so much. So if there are no questions here in this particular part of this question, then I shall be able to go straight away to Roman 3. These guys are very stupid. In quotes, they want me to give them the conversion what year? Premium per share. Conversion premium. Conversion premium. So conversion premium, we normally take in this case here, just 1 minute, 1 minute, sorry. Is there anybody who is able to give me that conversion premium per share themselves? We see. So remember, anybody who converts, if you convert share value will be 30 times 3.3 because each share is going for 3.3 today. Each is going for 3.3 today. All right. So are you able to give me this 30 times 3.3? 30 times 3.3. That will give me what figure somebody today? That will give me what figure somebody here? Remember, each share is going for 3.3. And you will be given upon conversion, you will be given 30 bob. Upon conversion, you will be given 30 bob. So 30 times 3.3 gives us what value? 99, isn't it? 99. 99. And then now go ahead. This is today, remember. This is today. This is today. From the time you given the promise today. All right. 3 years later, like the movies, 3 years later, what is happening 3 years later? So 3 years later, we have the conversion market value. The conversion market value. The conversion market value is the one that you got in Roman 1. The value that you got in Roman 1, you ninjas, the value that you got in Roman 1 was 117. Is there somebody who is able to remember this 117.6? Is there anybody who is able to remember that figure of 117.6? Is there anybody who is able to remember that figure of 117? The one we got upon conversion. Upon conversion. Then this premium, this conversion premium per share, you look at the growth. You look at the growth. So the growth is the premium. Growth is the premium. The growth is the premium. 117.6 minus 99. 117.6 minus 99. This will end up giving me what figure? 117.6 minus 99. That is the premium, you know. That's the growth here, which is 18.6. So in this case here, the premium per share, we know that there are 30 shares being involved. There are 30 shares being involved there. You divide that by 30. You divide that by 30. You divide that by 30, which will end up giving you what figure? which will end up giving us what figure, ladies and gentlemen? 0.62, right? 0.62. Thank you so much. 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 And please remember the hashtag is at RCM. Students who study at RCM, they are getting help loans over up to 60,000 Kenya shillings, a loan that will start repaying after 3 years. If there is anybody who is interested in that kind of a loan, and of course interested in studying at RCM, and of course which we shall be able to then apply for you for free, you should be able to get in touch with RISPA on all matters to do with help loans. This is a number you need to WhatsApp. This is a number you need to call. It will really be very good for you. Very, very, very good for you. So is that question clear? If they bring that kind of a question on an exam, will you guys be able to get something? Will you guys be able to get something? Will you guys be able to get something if they brought that kind of a question on an exam? All right. Thank you so much. Now I want to change gear a little bit. I want to change gear a little bit and go to the theories. We go to the theories. Let's now go to the theories. It will be very important for us to look at the theories a little bit. So many students who fail in these papers, they are not very good in terms of what here? Theory. They are not very good in terms of theory. Yeah, they are not very good in terms of theory. And why should you fail in your theories? Great. And all those ninjas, of course, who are following Mwalimu here on YouTube, they need to go to YouTube and do what here? Follow Joshua Aura on YouTube. It will be very good if you follow that ninja.